What's up, everybody? My name is Joe Brown. This is Heresy Financial, and today we are going to be looking at the dollar. The dollar has been spiking recently against the currencies that it is measured against. And so today we are going to be looking at number one, what is actually going on here? Why is the dollar spiking against some of the major currencies like the yen and the euro? We're going to take a look at the relationship there. And then just because that relationship is, I think, very widely misunderstood. And then the second thing that we're going to look at is what this could cause as a result. And so we're going to look at the reasoning why it's happening and what's going to happen or what could happen as a result. Ready? Let's dive in. All right, the first thing that I need to point out here is the relationship between the dollar and other currencies. If you take a look at this image, this is like a seesaw, like a teeter-totter that you played on when you were a kid, right? You've got one currency on one side, you've got your other currency over there on the other side. It is very important to understand that this is how currencies are measured. So when you look at the DXY, that is the dollar index, this is the dollar compared against a basket of other currencies. So when we talk about the reason why, well, before we get into the reason why, when we talk about just the fact of the dollar or another currency strengthening or weakening, this is what we are talking about. So if this side, the dollar, gets heavier, what's going to happen? It's going to push it down. This side is going to push it up, right? And so it can move, the relationship between these two can move because one side gets heavier, right? What happens if this side gets lighter? Then it could also move the exact same direction. So if I know it's got currencies here, and I know we're not talking about the real currency movements aren't, the strength or the weakness isn't based on heavy or light, but just for the illustration here, if the dollar side gets heavier, that would push the left down, the right up. If the euro side gets lighter, that would push the dollar side down and the right side up. So you would get the same movement whether or not it's caused by dollar strength or euro weakness, right? And so it's vital to understand that this is how currencies work. This is how they are measured, is just compared against each other. So you can say the dollar is spiking. That is the same thing as saying that the yen is dropping. It's the same thing as saying that the euro is dropping. And again, that's assumed because when we have to assume similar relationships, right? So when we're looking at the dollar, that's the DXY is measured against multiple currencies. So this right here is against the yen and the euro and others. The Japanese to USD relationship that we're looking at right here, this is just those two. So this is like that picture that we were just looking at. It's the yen on one side, the dollar on the other. Same thing with this one. It's the euro versus the dollar. And so we have to understand the relationships here because a lot of people are confused right now about why gold has been going up, right, over the last couple of days since the announcement of the taper, which if you watch my video on that day when they announced that we're starting the taper of their asset purchases, winding down the amount that they're adding to their balance sheet, not winding down their balance sheet, I said that that would probably be the bottom in gold. Well, since then, gold has only gone up, and confusing to some, the dollar has been going up as well. So number one, it's been hard on the yen. Now, one of the reasons for this is because of the relationship. You are going to start to get some selling in the yen here as a result of the move. These are a lot of money trades currencies, and it goes off of momentum, right? There's a lot of money that is trading these, just trying to switch in and out of one and the other and make money. So if we take a look, if we zoom out here, we can see that this level that it broke right down here, I'll put a little, well, let me zoom in here. I'm going to put a purple line so you can see. You're going to see that hit yesterday a level that was beneath all of the support that it's been, except for back, and you have to go back to 2017. So it's been a while since it's been this low, and it would indicate then that there's a possibility that we have a quick fall back down to the level that it was at here where we got some good support right there. And so what I'm showing you here is that the break beneath this level would indicate that we would start to see some more selling of the yen in exchange specifically for dollars, because it broke as momentum traders pile in, and that selling itself, that trade itself, drives it down. So it's kind of like a self-fulfilling prophecy. Momentum traders and anybody trading on technical analysis, this is kind of like a self-fulfilling prophecy where it's like, okay, if it holds, then everybody's going to buy. If it breaks, then everybody's going to sell. And then that selling itself will be what drives it down. And so we could see very easily the dollar continue to strengthen just on trading alone, just on the momentum alone of all of the money out there that is just trading back and forth between currencies. And this is something that I mention every once in a while, but one of the things that's important about a sound money system, where you don't have fiat currencies, where all countries' currencies are just compared against each other and dependent on how much they inflate compared to everybody else. One of the reasons why sound money system is so important, you can't have that where spending and inflation, it's tied to the real wealth. It's tied to something that can't be manipulated, expanded, or contracted at will, is because most of Wall Street doesn't exist with sound money. You take a look at this. This doesn't exist. It's just mind-boggling amounts of money going into trading currencies every single day. This is not something that adds value to the world. Most of this is not people hedging. And even if it is people hedging, they wouldn't have to hedge these movements if the world had sound money. So the fact that all of this currency trading exists, this is, number one, it sucks brain power because there's a lot of money to be made here, and it sucks a lot of talent, a lot of brain power. Some of the people that have the highest potential to produce real value to the world are trading currencies, because that's where you can make a lot of money, and it does not add anything economically to the world. It's a zero-sum game, and this would not exist if the world had sound money. And that's why the banks, the big financial institutions, don't like sound money, because it is a racket. You can make a lot of money with the fiat system here. But that is not what we're talking about today. We're talking about the dollar. So let's get back on track. Japan, based on the trading, the yen could fall further versus the dollar. That could drive the dollar up because Japan is a major portion of DXY, right? We are also seeing the reason why because of interest. Well, number one, because of inflation. So inflation numbers are continuing to break records over and over and over again. We're seeing inflation just break records. And despite prices going up, and it's not really despite, but that's what the media is saying, we are seeing sustained demand. And so U.S. retail sales rose more than expected in October, despite the price rise. And the media is kind of confused about this. They're saying, hey, prices are going up. Why aren't people backing off on the amount of money they're spending? And here is what is common across episodes of inflation all throughout history. When you go to the store and every month you see peanut butter got more expensive, my frozen pizza got more expensive, my beef got more expensive, what are you going to do the next time you go? You're going to buy a little bit more. You're going to buy a little bit more because if you wait until next month, well, it's going to be more expensive. So might as well front load some of your spending and save yourself some money that way. That is a real return on your money. If prices, just for even easy numbers, if prices go up 10% next month, you buy twice as much this month so you don't have to spend it next month. You made the exact same amount of money as waiting to delay that purchase to next month, investing the remaining money and getting a 10% return then in that month, then selling it and using that to make your purchase. Same exact thing. And so people aren't dumb for the most part. Just daily life actions and habits are for the most part rational by most people. So the fact that we're having U.S. retail sales rising more than expected, while we're having price inflation that is not irrational at all. It is in fact very rational that for months now people have been watching prices go up and up and up and up. They're going to start buying more now in anticipation of that, wanting to save some money. And so because of this inflation, we are having the market start to price in the chances that they're going to start raising rates. There's a 50% probability of a 25 basis point rate hike by July of next year. Basis point, in case you're not aware, 1 basis point, BPS, that is 1% of 1%. So 25 bips is a quarter of a percent. And so that's how much the Fed usually moves interest rates by, unless they're dropping them severely, like in the case of early 2020, to deal with something economic. And so the market is now trying to price in the probability of a rate hike, which, you know, the way the markets work, trying to price in the future, you're basically pulling future expectations from the future into the present. That's why stocks go up. That is just anticipation of future earnings, future growth. That is pulling that growth into the future in terms of price. It starts to price it in, because if something is guaranteed to happen tomorrow, if it's guaranteed that Apple's going to drop by 10% tomorrow, everybody's going to sell today until it reaches 10% down, and then the selling will stop, because that's how much is guaranteed to drop by, which means that that guaranteed drop for tomorrow happens today. So the more likely some move is to happen in the future, that starts to get priced into the present. And so we're already seeing, if we look at the 30-year, we're seeing interest rates up since the announcement of the taper here. If we look at the 20-year, interest rates are up. If we look at the 10-year, interest rates are up. If we look at the 2-year, interest rates are up. So the market is starting to price in the chances that the Federal Reserve starts increasing rates. And so this is one of the things that I was talking about when I'm saying, hey, they're announcing the taper, they're withdrawing the amount of bond purchases. So number one, you've got fewer buyers here, which means if you got fewer buyers, and you've got the same amount of sellers, like the federal government selling that debt, you're going to have that price move down, because you got fewer buyers, which drives the interest rates up, because interest rates and prices on bonds are inversely correlated. And so that is what we're having to start pricing in here, and that's what we're seeing the market is pricing in. Anticipation of the Federal Reserve trying to deal with inflation, because we continue to get records broken, and the market's now saying, hey, they're going to have to start doing more. Now, what are the problems with this? Well, we can see big problems with emerging markets, and this is where we get some massive problems here, because you do not want, I mean, every single time when you have the dollar start to strengthen significantly, unexpectedly, you have problems in emerging markets. And you can see here, we're seeing some trouble come out of Turkey, right? Because the dollar is going up. This is making it harder for emerging markets to be able to afford things when the dollar starts to rise. The Turkish currency fell to an all-time low of 10.44 lira to the dollar on Tuesday. And so makes it very difficult for emerging markets, because suddenly things get more expensive. They have to use more of their own currency to afford other things. And a lot of things in the world for international trade are priced in dollars. And so why does it matter globally to America, to some of the bigger, more developed economies? Why does it matter if this is hard on some of the developing or emerging markets? Well, it's because of this. Take a look at this chart. This is the Eurozone GSIB balance sheet table. So this isn't all of them, obviously. GSIBs, if you're not aware, is a title called Globally Systemically Important Banks. So this was a title given, I believe it was in like 2009, to certain banks that were deemed to be significant globally. And so these are banks in the Eurozone that are GSIBs. Take a look at these the balance sheet gearing and the market cap to balance sheet ratios. This is just unbelievable. You've got banks here with a market cap of 1.5%, 1.6%, 1.8% to their balance sheet. All right, so for an example here, so that you know what these numbers are, just so you know how crazy this is, This kind of looks like a very deep value stock. So you look at the market cap, let's say of Amazon is $1 trillion. And then you look at their balance sheet, and that's just let's just say it adds up all of their assets. And you take a look and see market cap is $1 trillion, but their balance sheet is, their market cap, $1 trillion is only 1.5% of their balance sheet. So you add up all their warehouses, let's say, and the value of their logistics and their website and all that. And you say, okay, well, the value of their assets is, let's say, 100 trillion, but they're only trading at a market cap of 1 trillion. That would signify that would be an indication that there's deep value there. That if they tomorrow went bankrupt, and they sold all of their assets off, you're guaranteeing yourself a win here, because they're worth their assets just by selling off of everything that they hold on their balance sheet. They'd get a lot more than what you would have to pay to buy their stock. But stocks don't really trade like this, at least today. They did after the Great Depression, and they do, in free markets after, panic, things like that. They don't trade like this today unless there's something deeply wrong. And that is key to pay attention to here, because they're telling us the market cap, or the price per share of these globally systemically important banks, are telling us there's something deeply wrong here. So what's on their balance sheet? Well, they don't have warehouses and assets and websites like Amazon. They have relative value trades. So they have something where you've got, you short one thing and buy another. So for an example of this that's really easy to understand, we know that if you look up Google stock, GOOG, you have GOOG is Alphabet, and this is Class C, right? But you also have GOOGL, and this is Class A, right? So these are going to move pretty much identical to each other, but you've got different classes of shares. One is 29.60.94, and the other one is 29.84.99, or 20, that's post, so 29.81.24. So they trade very similar to each other percentage-wise. They're going to keep almost identical, but there's a difference between the shares, right? The difference is going to be voting rights. One class has voting rights, the other class does not. So why does this matter? Well, let's say you notice a discrepancy, and you notice, hey, they've diverged in terms of how much they're tracking each other, and you think they're going to come back together. So Class C shares are trading at 29.81, and Class A shares 29.60. So you would look at this and pretend this isn't trading advice. I'm not saying to do this because I don't know if they're going to converge or not. They probably won't. But you would look at this and you'd say, okay, I'm going to short the higher one and I'm going to buy the lower one. So if you short the higher one, you get $2,981. You buy the lower one, you spend $2,960. That means you're going to net a positive $21, and you're going to have offsetting positions, because for the most part, they're going to trade up and down together. And so you don't really have to worry about the higher one just exploding that you shorted, and then the bottom one just dropping that you bought, and then have to cover the difference. What you're looking at is, hey, I'm going to wait for them to converge from $21 to $20 or to $19. Then I'm going to close out the trade, and then if they ever if they get closer, then I might wait, and then if they get further apart. So these are relative value trades. You're shorting one thing and then using the proceeds to buy another thing that theoretically should move almost identical to each other, but you're taking advantage of this spread. That's an arbitrage play. So banks like this, they're not doing this with Google stock. They're doing this with bonds and currencies all around the world. And so because they have positions that mathematically, statistically, based on value at risk and other stupid valuation and calculations, they're loading up with a ton of leverage on these trades, because the math says, hey, the chances of you losing on this are 0.0001%. Then they're able to lever that up and use a ton of debt to do that. So that's why their balance sheet is so much larger than their market cap, because they've levered up on these massive trades. So why is that dangerous? Well, what happens if you have I don't know, a default in Argentina, which has never happened, right? Except for the 4 times that's happened in the last, 50 years. What if you have a default in somewhere in South America, somewhere in Southeast Asia? What if you have something happen to Turkey that is completely unexpected? Well, these relative value trades suddenly start to blow up because something happened that wasn't supposed to happen. And because they're so highly levered, now they have to start unwinding. Well, what did we look at back here with the Japan to USD? When this drops below this level, which remember was support for so many years until we get back to 2017, what happens? Well, because it dropped, everybody starts doing the opposite. And what does that do? That starts to drive it down even more. It's a self-fulfilling prophecy. So when you have a levered balance sheet and then you have something move that wasn't supposed to move, let's say you've got Google, this is the more expensive one, Class C 2981. Let's say that starts to move up, and then you've got Class A starts to move down. Well, suddenly you're looking at this and thinking that wasn't supposed to happen. So now to close out that trade, because you can't keep it up, you're going to have to buy back to close the one that you shorted and sell to close the one that you bought. Well, the one that you shorted is higher. So now you're adding to the fire, adding fuel to the fire. It's driving it up more. And then the one that you had to sell to close out drives it down more. And so now it's not just you that's in trouble with 1.5%. Now it's everybody who has exposure to those trades is in trouble, because you having to close out because you were the most exposed now makes everybody else's positions have more of a loss. And then you have the potential for more to have to start closing out. So none of this is inevitable. I'm just giving you an example of why dollar strength, especially unexpected dollar strength, many times leads to problems in emerging markets, and why that rolls over to the rest of the world, because you've got massive financial institutions like this that are levered up to their teeth and they can't afford an unexpected move to happen. And then that starts to roll over, and then you have the central banks around the world have to start a new bout of printing, start buying up this junk so that it doesn't collapse the markets and produce panic across the global financial system. And then you see something like that trigger a reversal in the Federal Reserve or other central banks around the world, their monetary policy, where they were saying, hey, we're going to pull back, triggers a problem. Now they can't. And then once most of the world realizes that this is a never-ending game, most people don't know this yet. Once most people realize the inflation is here to stay, the monetary policy, easy monetary policy is here to stay, and any time they try and pull back on it and stop it, they're inviting calamity, inviting a deflationary death spiral and just collapse everywhere. Most people are going to try to exit the system, which is going to accelerate the end. So that's what we're looking at here. I hope that helps your understanding of what's going on with the dollar strength and why it could lead to problems in emerging markets, and then from there into developed markets around the world. As always, really appreciate you guys. Thank you so much for watching. Have a great day.